Go to NVIDIA. I don't own it, but they grew earnings 54% and total revenues of 55%. And the one I do own in the semiconductor world is Broadcom, up 36% in earnings and up 22% in total revenues. To me, when you see companies that are making money and they're pulling back and they're trading at a lot more healthier multiples, they're still rich, but I see that growth and that tailwind, I want to be buying, and that's what I've been doing. I added to Meta and I added to Microsoft.
Mary Erdos was there of JP Morgan. She runs asset management and wealth management. She's the CEO. She was asked a question by Leslie Picker about a bubble. It's going to lead me to you. And here's what she had to say about where we are.
AI itself is not a bubble. That's a crazy concept. That's like saying our computer's a bubble. Like, we are on the precipice of a major, major revolution in the way that companies operate, efficiencies are found, and reaching your client in a whole different paradigm. The valuations of certain companies are reflecting what they think, what the markets think are going to be the winners and the losers.
Now with more on the concerns about GPU depreciation. Seema?
Well, John, as you know, high-performance AI chips do not lose value like cars do the minute they leave the dealership. Hyperscalers like Oracle are buying these advanced GPUs at breakneck speed with the expectation that they won't depreciate for roughly 6 years. But Big Short investor Michael Burry, weighing in this week, he thinks it's closer to 2 to 3 years, fueling this debate as to whether cloud computing companies are overestimating one of their biggest expenses tied to AI data centers. Bank of America sees Oracle's CapEx investments remaining high even after 2030, as the majority of their costs are tied to GPUs with, quote, short useful lives. The problem is no one has a definite answer on the life of these incredibly advanced technologies because the industry is still in the early phase of this AI infrastructure build out. We spoke to a number of other investors who say that this transition from training to inference may also introduce cheaper, less powerful alternatives. John.
Seema, thank you. My next guest says Michael Burry may be right about some specific companies, but the biggest risk remains under-investing compared to over-investing. Joining me now is Daniel Newman, CEO of Futurum Group. Daniel, great to have you on Overtime. Finally. Okay, so this is kind of pitting NVIDIA and its set against the big cloud players, the hyperscalers, because if you're NVIDIA, you want people to need a new chip every couple of years, but if you're the cloud players and they're accounting, they want to be able to convince us that, no, these chips are going to be good for a while, right? Who's right?
Well, I think they're both right in part, John. And by the way, great to be here with you. First of all, NVIDIA and Jensen will get on stage and he will absolutely say, look, the more you buy, the more you save. The next generation of chips is going to be exponentially more efficient, more tokens, better economics. But at the same time, you have to weigh that against the CapEx, the cash burn, the depreciation impact that it might have. And you have to weigh it against what customers need. And in Seema's report, she said something that is really important. And what's important is we don't know 100% yet how these workloads are going to impact these newest variations coming out from NVIDIA, from AMD. What we do know is that TPUs, we know that a number of older generation NVIDIA chips, the V series, A series, are still being used and still able to command meaningful commercial pricing from their users. But this is all about supply and demand. Right now, there is no equilibrium. So every chip that's available right now, there's someone out there that's willing to use it for an AI workload. If we truly meet some type of equilibrium towards the end of the decade, which is when we expect that to be possible, this is where that depreciation issue could get really significant for companies like CoreWeave that are taking 6 years. Go ahead.
I just wonder, for the likes of a CoreWeave, do they really necessarily have until the end of the decade? Because chances are somebody's overbuilding here. But if you are a Google, a Microsoft, an Amazon, you have your own workloads to have to deal with, so you can get useful life out of those data centers that you've got, and you don't have to worry so much about overbuilding. But if you're doing this stuff on spec, aren't you potentially exposed?
Well, you bring up a good point. I do think when that supply-demand curve, finds that balance, that risk is there. We don't have any indicators, though, from any of our sources across all of the supply chain, all the channel checks. This doesn't really matter, John, if it's turbines. It doesn't matter if it's the concrete that they're pouring to build these buildings, or, of course, it's the enterprises consuming this technology that we are going to get there. I spent time with Lisa Su this week at AMD's Investor Day. She's one of the more conservative CEOs we know. She felt very confident in terms of doubling the size of her TAM. Now, that included networking and CPU chips. But that number, that growth number coming from her, she's seeing margin growth. She's seeing her data center number grow. It's growing in every part because they can't find enough supply. So I do think until the music stops.
But I mean, do we have to wait until the music stops? Or if the music just sort of fades a bit, does it start to have an impact? Because a lot of these valuations are not based on a light switch on or off. Is there demand or isn't there? If demand starts to slow down and you see people having to pull their numbers and say, oh, well, maybe we're not as constrained as we were, that's going to have some impact on investors' view on valuations, won't it?
Yeah, I 100% agree. I've been a little nervous about CoreWeave since its IPO. I've said both the combination of a 6-year depreciation model and the fact that they collateralize the GPUs definitely creates risk, especially because there's not a lot of value-added services in bare metal. And we're seeing other hyperscale and, of course, AI utility companies. We've seen some of these Iron Limiteds and other companies that have come up that are doing full stack, offer the energy complex, which is one of the biggest constraints is energy. We have it with memory. And right now, if you're just offering more compute, what we do know is the hyperscalers will use it, but it's not their preference. They're doing it because it gives them immediacy.
Right.
And once they don't have that need for immediacy, all those holding too much capacity are at risk, and that depreciation schedule could cause some real problems.
I got a theory I want to check with you off of a conversation I was having with the CEO of D-Matrix this week, and that's the idea that these biggest players who are really just burning it up in the markets right now, they're going for home runs because they have to. If you're Microsoft, if you're Amazon, if you're Google, you know that you're going to be fine when the tide goes out no matter what because you got huge cash flow. Mark Zuckerberg even said it. So the downside is if you don't spend now and you end up underpowered and one of your competitors races ahead of you, then you lose. But if demand slows down for a bit and the market goes down, well, you don't entirely lose. You just, have to stick it out for a while. So maybe these giants are playing with a better deck of cards than your investor at home, no?
No, they absolutely are. If you look at when Zuck went with Reality Labs, he did this experiment. It was a much less exciting technology than AI, but he actually turned the crank, went big on investing, saw the market's reaction. He's not completely given up on it, but then when he cut back OpEx and turned back towards focusing on the company's cash machine, you saw that stock rise monumentally. He knows they can pull on this lever. And this thing about these companies, though, is they do know that they will get to the point where this turns into lower OpEx, higher revenue returns. It drives significant growth to the business, but they're okay. They're willing to sacrifice maybe some short-term impacts to EPS because they know they're going to get there and they want to maintain their positions as leaders, as the Mag 7 is the biggest companies in the world.
Great perspective. Well, let's look at the NVIDIA chart because that's going to be a huge impact, I imagine, on the markets next week, at least potentially. Well off the highs, but, at this level, I don't know, it looks interesting to me, but I'm no chartist.
It is interesting. And actually, I think it's better for NVIDIA to be coming into its earnings report next week, short-term oversold as opposed to short-term overbought. But ideally, we see NVIDIA stabilize near some support on the chart. It's essentially around 180 to 190, so pretty close to inline. There is some support for NVIDIA. It's based on our daily cloud model. And with short-term oversold conditions there, it has a better chance of holding. But I would be taking a wait-and-see approach rather than adding exposure if I didn't already have it, because I want to see that reaction to earnings to see if it manages to continue to hold, given the loss of momentum that is certainly evident in those weekly indicators.
And NVIDIA tends not to, well, I guess by nature, lately sell off and stay off for long. If it does, are there things that tend to follow? What kind of influence does this stock have now?
Well, I think it's a huge, huge influence on market sentiment, especially in the retail camp. Folks are tying it to the AI trade, we have seen some of the high flyers within the AI trade pull back in a pretty notable way. So their pullbacks now reflect a loss of momentum that's carried over to those same intermediate term metrics. So if that happens or continues to happen with NVIDIA, it extends its corrective phase. I do think it will be an influence on anything that's tech related, really. So the tech sector as a whole. And when the S&P 500 loses the support of the tech sector, that of course becomes somewhat problematic. So we're going to take that wait and see approach until those indicators on the weekly charts look better. We wouldn't feel comfortable adding exposure. In fact, we've been recommending to our clients for a few weeks now to be partially hedged just to mitigate that risk.
Pivotal moment coming up on Overtime next Wednesday. Katie.
With NVIDIA, definitely going to be most important.
Yeah, but as you said, given the questions, the sentiment, the buzz out there about how much longer can this go, Jensen Huang always has a broader perspective to bring about what he thinks the pipeline looks like and what kinds of innovations it's going to drive across the global economy. How much has that tended to influence then the valuations of other companies, and how much is that driving the market?
No, I mean, it's been a weird dynamic lately. We've heard from a lot of companies that have plenty of AI exposure this week. You know, we've heard from Foxconn, we heard from AMD, we heard from Cisco, and everyone is still as bullish as ever in terms of near-term demand trends. I think the bigger question that's really kind of weighed on the space is more longer term, looking out over the medium and longer term, and just kind of skepticism and questions about translating some of these massive bookings numbers into revenue. And it's unclear if NVIDIA can really provide a ton of guidance on that front right now, even though the numbers and guidance are expected to be healthy, because we saw that from out of those other companies I just mentioned. You know, AMD on Tuesday was very bullish on the backdrop for AI chip demand going out over several years.
Wednesday night's the big night of the week, the biggest night, because NVIDIA reports. NVIDIA is at the heart of the data center because the chips power accelerated computing and artificial intelligence. Besides hearing how the company's doing, we need to hear about the next iteration of chips, the Vera Rubin, and whether it's ready and whether it'll be a seamless transition. That will keep the company well ahead of AMD, by the way, who still is their chief rival. No, I don't expect anything from China. I think that's a dead issue now. If NVIDIA is strong, I think it can ignite not a bounce, but a true rally itself. I continue to say, own NVIDIA, don't trade it, and that's our position for the Charitable Trust. I can't stress enough how important NVIDIA is to this market, because there's no AI revolution without NVIDIA. But with it, we could still have a multi-year move, something that an old friend of the show told me, Dave Cote, now the chairman of Vertiv, which is key to keeping these red-hot data centers cool. They own the best air conditioning company. Now, I think Cote's appearance on Squawk on the Street this morning actually catalyzed the bull market, because it was so darn bullish, and Cote is as rigorous as a business person I've ever met. I could see things turn around. It's why you got to watch Squawk on the Street. Give me a break. You got a good number from NVIDIA and a big boost from the forecast. Next thing you know, the other 6 members of the Mag 7, they're going to start roaring.
That was easy.
All right, I hope you're all doing well today and staying calm in this market. Recently, the Wall Street Journal reported that Amazon and Microsoft have come out in favor of the GAIN AI Act. The headline of the Wall Street Journal article focuses on China, but that's irrelevant as NVIDIA isn't allowed to sell into China anyways due to export controls. I want you to ignore China for a moment because it's irrelevant for right now on the topic of the GAIN AI Act. The GAIN AI Act would require that advanced semiconductor companies such as NVIDIA ensure that all domestic U.S. demand is fully met before they can export advanced semiconductors to countries around the world. It has already passed the Senate, and now we're waiting on it to be voted on by the House. I understand that the bill may sound good at first, and it may come from good intentions, but I honestly think the bill would have unintended negative consequences that many lawmakers are not considering right now. If the GAIN AI Act is signed into law, U.S. chip makers will lose market share in various markets around the globe, and this will create the opportunity for Chinese competitors like Huawei to step in and fill the gap. And once you lose developers to another ecosystem, it will be difficult to get those developers back on the American tech stack. This would be a strategic mistake on the part of the United States. It is to the United States' benefit that developers around the world build on the American tech stack and continue to be reliant on American technology. That is a major strategic advantage to the United States. And again, put China aside for a moment because we're talking about other countries besides China when it comes to the GAIN AI Act. NVIDIA has been vocal in their opposition to the act, saying that it seeks to solve a problem that doesn't exist and that NVIDIA never deprives American companies in favor of foreign customers. Earlier this year, I said that the AI diffusion rule was a bad idea, and it was a good thing that it was repealed. After that, I said that the export control controls on NVIDIA chips to China would result in China substantially speeding up the development of their own chips to compete with NVIDIA, and that turned out to be correct. And now I'm saying that if the GAIN AI Act is signed into law, it will result in American chip makers losing market share in various markets around the globe, and it will swing the door wide open for Chinese companies like Huawei to step in and take those markets. If developers cannot access American technology, they will turn to alternatives, including Chinese alternatives from companies like Huawei. That would be a major strategic mistake on the part of the United States. Please bear in mind that I am politically independent and nothing that I say is motivated by politics. Also Friday, we learned that StarCloud has officially launched NVIDIA GPUs into space. You may remember that we spoke about StarCloud maybe a month or two ago. StarCloud is a startup in the NVIDIA Inception program, and they officially sent NVIDIA H100s into space, marking the first time a state-of-the-art data center class GPU has been in outer space. Building data centers in space is such an interesting concept, as there is near infinite renewable energy from the sun, and there's no need for water for cooling due to the vacuum of deep space. Also, Friday, Google announced they will invest $40 billion in 3 new AI data centers in Texas through 2027. Another indication that the world is capacity constrained in the face of strong AI demand. Also Friday, we learned of 2 price target upgrades. Morgan Stanley raised their target from $210 up to $220, and Wells Fargo increased their target from $220 up to $265. I don't put a lot of weight behind analyst price targets, but I mention it so that you know what's going on. And I continue to think that most analysts' long-term NVIDIA estimates are too low given what's ahead. Looking ahead to earnings next week on Wednesday, November 19th, we're expecting revenue growth acceleration given NVIDIA's Q3 guidance and due to the swift production ramp of Blackwell Ultra. As a reminder, we were expecting Blackwell Ultra production to ramp substantially starting in September. And Foxconn just recently reported very strong earnings and guidance, saying that AI rack shipments increased 300% quarter over quarter and are expected to double in Q4. Foxconn's very strong report is a strong indication that Blackwell Ultra production has ramped substantially in a very short amount of time. That bodes well for NVIDIA. I also expect Jensen to talk about agentic AI on the earnings call, given his previous commentary. I'm expecting a surge in compute demand fueled by agentic AI that extends well into 2026. I also expect a key question on the earnings call to be the question about the useful life of a GPU, given Michael Burry's recent comments. In case you missed it, Michael Burry recently posted on X saying that hyperscalers are understating the depreciation of GPUs, and that by extending the useful life of those assets, they are artificially boosting earnings. I disagree with this analysis, as I've discussed in previous videos. In short, I disagree with the premise that the hyperscalers are claiming a longer useful life on the GPUs in order to artificially boost earnings. Rather, I think the hyperscalers have simply come to the realization that the useful life of the GPUs is longer than what they originally estimated due largely to 2 factors: NVIDIA's continuous improvement of older generation hardware through software, and second, a severe shortage of compute in the face of extremely strong AI demand. Since the world is compute-constrained, developers will use whatever compute they can get their hands on, including compute that under normal circumstances would be considered older generation. This extends the useful life of the hardware. Additionally, we have to consider inference. Real-time inference substantially increases the need for more compute, and the introduction of advanced reasoning models and real-time inference is something that Burry fails to mention in his post on X. It's not enough to simply train AI models. You then have to provide access to those models at scale through real-time inference. If we thought training required a lot of compute, what about real-time inference processing billions upon billions of tasks every single day? This drastically increases the need for more compute in a world that was already compute constrained, and thereby increases the useful life of the compute that is available. Now, if we eventually get to a point where the world is no longer compute constrained, then that changes things. But I honestly think we are at least 3 to 5 years away from something like that happening, if it happens at all. Jensen appears to agree with this time frame, given his commentary on the BG Squared podcast back in September. Also be prepared for November 25th. That's when Burry is revealing something else. I think he may be starting a blog, but I'm not sure. And Burry told us in his post to expect more detail about GPU depreciation and the hyperscalers supposedly overstating earnings. I would not be surprised if tech stocks, including stocks like NVIDIA and Iron, were to react negatively when that is released, even if Burry's analysis turns out to be incorrect. So be prepared for that, just in case on November 25th, we may see some volatility. Really quick, I want to mention that I'm still bullish on Iron for at least the next 1 to 2 years. And I'm viewing this pullback as an opportunity to responsibly add to long-term positions. I'm not telling you what to do, and this is not financial advice. I'm just sharing my honest opinion. The reality is that the world is compute constrained, and Iron will most likely sell whatever capacity they can produce over the next couple years. Iron announced earlier this month that they expect 140,000 operational GPUs by the end of 2026. From those 140,000 GPUs, Iron is expecting $3.4 billion in annual run rate revenue. If you apply a conservative price to sales multiple of 10 to that, then you're looking at a market cap of $34 billion. If you apply what I think is a more reasonable price to sales multiple of 15, then you get a market cap of $51 billion. And that's just for the 140,000 GPUs. The 140,000 GPUs will use 460 megawatts of power, so 16% of Iron's total 3 gigawatts of secured renewable power. This means that Iron has plenty of room to expand even after the 140,000 GPUs are deployed. I understand that the short-term price action hasn't been great over the past couple weeks, but I'm viewing this as a long-term investment for at least the next 1 to 2 years. I think this company will be worth notably more over that time than it is today, purely based on the fundamental trajectory of the company. This is not hype, it's fact. I seriously encourage you to research Iron and consider it from the perspective of a potential long-term investment for the next couple of years. Don't get distracted by the noise or the short-term price action. Focus on the fundamental trajectory of the company. Now going back to NVIDIA earnings. I'm expecting NVIDIA's earnings to be very good, but I don't know how market participants will react to NVIDIA's earnings. I don't know what will happen in the short term. But from a long-term perspective, I continue to be bullish on NVIDIA, and I genuinely think that this company has plenty of runway ahead of it. As I mentioned, I think we're likely to see a surge in compute demand fueled by agentic AI that extends well into 2026. After that, I think the next major surge in compute demand will likely be fueled by physical AI. Physical AI is a massive long-term growth opportunity for NVIDIA, and I don't think it gets enough attention. NVIDIA sells the hardware for the data centers where the models are trained. They offer Omniverse where the models are taught and tested, and NVIDIA also sells the hardware that allows on-device real-time inference through NVIDIA AGX, allowing robots to have intelligent interactions with the real world even when they are not connected to a data center. Notice that NVIDIA is taking a holistic platform approach to physical AI, and they're embedding themselves as the underlying foundation supporting all of it. Over 2 million developers are already building on the NVIDIA robotics stack. Physical AI will fundamentally transform society, and NVIDIA stands to benefit massively. This is not getting enough attention right now, but I think it will get a lot of attention in 2026 and 2027. In addition to physical AI, NVIDIA has multiple other large long-term growth opportunities, including sovereign AI, enterprise AI, many AI-native startups, telecommunications, and 6G and quantum GPU supercomputing. Jensen believes that quantum computers will not replace classical systems, but that they will work together and complement each other. These additional opportunities in customer segments will increase the need for compute even further. As for production ramps, Blackwell Ultra is ramping very quickly right now, leading to revenue growth acceleration. Rubin is on track to launch in 2026. Then we're expecting Rubin CPX at the end of 2026. Later on, we're expecting the launch of Rubin Ultra in 2027 and Feynman after that in 2028. We have a clear data center product roadmap stretching into 2028, and Jensen believes there will be $3 to $4 trillion of global AI factory build-out between now and 2030. That means Jensen is expecting growing AI demand and an expanding total addressable market underpinning all of this. I don't think we are anywhere near any type of bubble bursting type of event. With all of this in mind, I seriously think that NVIDIA still has plenty of runway ahead of it, and I think this company will be worth substantially more in future years than it is today. At least that's my view of the situation. Remember to stay calm in this market. Remember to maintain a long-term perspective, and do not make any hasty or irrational decisions. With all of that being said, I hope you all have a great rest of the day, and I'm curious to hear your thoughts about NVIDIA in the comments below. Please leave a like on this video so more people will see it. And while you're down there, please consider subscribing. It's free, and you can always change your mind. Thanks for watching, and hopefully I'll see you in the next video.